Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Delta Airlines.
If you find our talks useful, please consider subscribe, like, and comment underneath. It really does help us get this information out to more listeners like you.
Today is going to be a fascinating one because we are looking at a legacy carrier. I mean, a company people usually associate with heavy machinery, unions, and just burning cash.
Right.
But it has effectively transformed its entire business model. We're talking about a fortress balance sheet, a projection for 20% earnings growth in 2026, and despite all that, it is trading at a discount compared to competitors.
See, that's a hefty promise. I have to be the skeptic right out of the gate here. The aviation industry is, historically where capital goes to die.
Oh, absolutely.
You've got high fixed costs, volatile fuel prices, labor disputes. I mean, Warren Buffett avoided airlines for decades for a reason. Are you telling me Delta has actually cracked the code? Or is this just a lucky cycle?
No, I really think they've cracked it. And that skepticism you just voiced, that is exactly why the opportunity exists. The market, it just hasn't fully caught up to the transformation yet. It's creating this window where the fundamentals are screaming growth, but the stock price is still sort of muttering legacy airline.
Okay, I love a good mispricing story. If market is wrong, let's figure out why. Let's look at the scoreboard first. It's Monday, February 16th, 2026. Where are we standing with the stock right now?
As of mid-February here, Delta is trading right around $69.50.
$69.50. And how does that compare to the rest of the field? Because I've seen some headlines about Southwest lately, and they seem to be on a tear.
They are. Year-to-date, Delta's up about 6.3%. Now, in a vacuum, that's a decent return for 6 weeks into the year.
For sure.
But if you look at Southwest Airlines, they have surged 23% in the same time frame.
Ouch. So Delta's lagging behind the low-cost carrier significantly. That usually signals that investors think the growth story is over at Delta and the value is over at Southwest.
It feels like that, doesn't it?
It feels like the market is picking a favorite.
On the surface, yes.
Yeah.
But this is where we have to, put on our analyst hats and look at the setup. That lower performance isn't necessarily bad. It represents what we call a consolidation phase.
Okay.
You have to remember, Delta just came off a very strong Q4 earnings report.
Oh, yeah.
The market is just digesting that information.
So it's taking a breather, like a runner catching their breath.
Precisely. We saw a pullback on February 12th, about 2.7%. Now, to the untrained eye, that looks like a drop or a loss of momentum.
Right. A red day.
But to a technical analyst, that looks like a healthy pause. It's not a reversal of the trend. The stock is stabilizing right near that $69.50 mark.
It's basically building a base camp before the next climb.
That's a great analogy. It's setting up for a potential breakout as the market catches up to the underlying business reality. And that reality is what I really want to dig into today because the profit engine of this company has fundamentally changed.
Let's open up the hood then. What is driving this thing? Because I'm looking at the data here. $63.4 billion in operating revenue for 2025. That is a staggering number.
It's massive scale.
But big revenue doesn't always mean big profit.
Correct. In the airline business, revenue is vanity, profit is sanity. We've seen airlines generate billions in revenue and still go bankrupt because their margins were razor thin.
Of course.
What matters is how they're making that money. And this is the core shift that I think a lot of retail investors are missing. We are witnessing a high-margin revolution at Delta.
High margin and airlines usually don't belong in the same sentence. I mean, usually you're fighting for pennies on every ticket, competing with the budget carriers who will fly you there for the price of a sandwich.
Not more. Get this, 60% of Delta's revenue now comes from premium seats, loyalty programs, and ancillary services.
Wait, 60%? So the majority of their money isn't just selling a standard economy seat from New York to LA.
Exactly. And that is the pivot point. It's not about selling a commodity seat from A to B anymore. It's about selling a premium experience. It's the credit card spend, it's the lounge access, it's the economy plus upgrade, it's the cargo.
That changes the whole risk profile, doesn't it? Because those things are stickier. If I'm just buying a seat, I'm buying the cheapest one. If I'm buying into an ecosystem, I'm much less likely to switch.
So much stickier.
Yeah.
And less price sensitive. If you're a business traveler or a premium leisure traveler, you aren't scouring the internet to save $10 on a ticket if it means losing your legroom or your lounge access.
You pay for the experience.
You pay for the experience. This mix gives Delta a unit revenue premium of nearly 115% compared to the industry average.
Can we pause on that metric? 115% unit revenue premium. Break that down for the listener who might not speak airline analyst.
Sure. Think of it like a hotel. If a budget motel and a luxury hotel have the same number of rooms, the same units, the luxury hotel charges double or triple for that same square footage because of the brand, the service, the amenities. Delta is effectively doing that. For every unit of capacity, every seat mile they fly, they are generating 15% more revenue than their average competitor.
So they are extracting significantly more value from the same assets because of that brand power. And I assume that flows directly to the bottom line.
It does. Look at the earnings power. Q4 2025, they beat estimates with an adjusted EPS earnings per share of $1.55.
Eat the street, always a good sign.
And for the full year 2025, GAAP EPS was $7.66. But here's the kicker, and this is why we're talking about this stock today.
Okay.
Management is guiding for 20% earnings growth in 2026.
20% growth on top of a record year. That is aggressive. Usually when you get to this size, growth slows down, you become a utility.
It is aggressive. They are projecting earnings per share between $6.50 and $7.50 for the long term, but specifically looking at that 20% jump this year. When a company with this much scale tells you they're going to grow earnings by 20%, you have to pay attention.
Right. It suggests they have pricing power that the market isn't giving them credit for. Okay, so the engine is running hot. They're making money hand over fist on premium seats and credit cards. But we have to talk about the balance sheet. I feel like every time I read about airlines, it's about how much debt they took on during the pandemic just to survive. Is Delta still drowning in IOUs?
That is the second pillar of this thesis. We call it the fortress balance sheet. The deleveraging story here is actually dramatic.
Unpack that for us. How much have they actually paid down?
During the pandemic lows, their leverage ratio was nearly 5.0x. That is risky territory. That's the kind of debt load where one bad quarter puts you in bankruptcy court. Today, it's down to 2.4x.
Wow. That is more than cut in half. That's moving from distressed back toward investment grade.
It's a massive turnaround. They have aggressively paid down debt. They generated $4.6 billion in free cash flow in 2025 alone.
$4.6 billion in free cash. Just to clarify for everyone, that's money left over after paying the bills, buying the fuel, paying the pilots, and even maintaining the planes.
Correct. After all capital expenditures for operations, that is, cash they can use to pay down debt, which they're doing, or return to shareholders. And speaking of safety, they also have $35 billion in unencumbered assets.
Unencumbered, meaning assets they haven't pledged as collateral for loans?
Exactly. It means they own them outright. Planes, engines, slots at airports.
Why should the listener care about unencumbered assets? Is that just accounting jargon, or does it actually help the stock price?
It matters because it's your safety net. If we hit another recession, or heaven forbid another pandemic, Delta has $35 billion worth of stuff they can borrow against to survive.
It lowers the risk?
It lowers the risk profile of the stock significantly. But in good times, like now, it means financial flexibility. When your credit card is maxed out, you can't buy dinner for your friends. When you pay off the debt, suddenly you can start paying dividends and buying back stock. And that is exactly what we're seeing happen.
Which brings us nicely to the news cycle. You mentioned shareholder returns. I saw a headline about a dividend.
Yes, confirmed. The board approved a quarterly dividend of 0.1875 sales per share, payable on March 19th, 2026.
Okay, let's be real. That's not a huge yield. You aren't buying this for the dividend income, like utility stock.
No, you aren't. But it's a signal. Management is saying, we have enough consistent cash flow to commit to paying you every quarter. It's a confidence vote.
Right.
But the news isn't just about dividends. It's about where they're going next. Have you seen the updates on Hawaii?
I did see that. Delta is adding routes to Hawaii.
Oh.
Which feels like, well, who doesn't want to go to Hawaii? But strategically, does that really move the needle for a company this big?
It matters because of who they're fighting. It's a direct blow to Southwest. Southwest has been trying to dominate that leisure corridor. Delta, stepping in with more routes, is them saying, we are coming for the high-margin leisure traveler. The person who wants lie-flat seats to Honolulu, not just a cramp seat with a bag of peanuts.
So they are taking the war to Southwest's turf, but with a premium product. They aren't trying to beat Southwest on price. They're trying to beat them on comfort.
Exactly. It goes back to that segmentation we talked about. They're skimming the cream off the top of the Hawaii market. And they are playing the long game on the fleet to support this. They have orders in for Airbus A330-900s and A350-900s. Now, delivery for these is 2029 and beyond, so it's not tomorrow.
That's a while away. Why should I care about planes arriving in 3 years?
Because the market likes visibility. It signals long-term efficiency planning. These are fuel-efficient, wide-body jets designed for international long-haul domination. It tells investors that Delta plans to be the leader for the next decade, not just the next quarter.
It's a roadmap.
It creates a roadmap for margin expansion because these planes are cheaper to fly than the older ones.
So the sentiment right now, if you had to put a label on it.
Cautiously bullish, the news cycle supports growth, specifically this international expansion and the balance sheet repair.
Okay, cautiously bullish sounds prudent, but let's play devil's advocate. I'm looking at the insider trading reports here in the notes, and I see red. Insiders sold over 23,000 shares in the last 3 months.
I knew you'd bring that up. It's the elephant in the room.
Well, it has to be addressed. If the executives, the people who know the numbers better than anyone, are selling, why should I be buying? What do they know that I don't?
It's a fair question, and it's the first thing we look at in risk assessment. But we have to look at context. Delta has a market cap of over $45 billion, 23,000 shares.
Okay.
In the grand scheme of things, it's a rounding error.
So it's not a mass exodus.
Not at all. It likely represents portfolio rebalancing. You have to remember, executives get paid in stock. Sometimes they need to pay taxes, pay for a kid's college tuition, or buy a house.
Right, life happens.
Selling 23,000 shares across the entire executive team is modest relative to their holdings. It doesn't signal a lack of faith in the company, especially when you weigh it against the buybacks and the dividend. If they were dumping millions of shares, I'd be worried. This is noise.
Okay, so maybe I'm overreacting to the insider sales. But what about the competition? You mentioned Southwest earlier. They're up 23% this year because they changed their model, right? Assigned seating, charging for bags. They're becoming more like Delta.
They are. Southwest is trying to move up market because that's where the money is.
Yeah.
And that is a risk. If they get good at it, they could chip away at Delta's customers.
Right. If I can get a similar experience on Southwest for cheaper, why fly Delta?
That's the if. Delta's defense is its premium brand and its moat. The moat here is that 115% revenue premium we talked about. Business travelers are loyal to Delta because of the global network, the sky clubs, the reliability.
Okay.
It is very hard for a low-cost carrier to suddenly convince a corporate travel manager to switch accounts just because they added assigned seating.
It's the difference between a motel renovating its lobby and a luxury hotel. The luxury hotel has a reputation that takes decades to build. You can't just paint the walls and call yourself the Ritz.
Perfectly put. Delta creates switching costs. If you're a Diamond Medallion member, you are not switching to Southwest to save $50. You lose your upgrades, your status, your lounge access. That ecosystem is the moat. Southwest is trying to build that, but Delta already owns it.
I want to touch on one more risk metric I saw in the notes, the Altman Z-score. It's sitting at 1.48. My cheat sheet says anything below 1.8 is the distress zone. Is Delta about to go bankrupt?
Theoretically, yes, that score puts them in the distress zone, but I am going to dismiss that as outdated math in this specific context.
That's a bold move. You're ignoring a standard bankruptcy predictor.
I am, and here's why. The Altman Z-score struggles with capital-intensive industries that have recently deleveraged. It doesn't fully account for the massive cash flow generation, that $4.6 billion in free cash flow we talked about.
Okay.
A company generating that much cash is not in distress. It's just that the balance sheet formulas haven't caught up to the post-pandemic recovery speed. It penalizes them for having high assets and high liabilities, which is just the nature of owning planes.
So don't panic over the Z-score.
Do not panic over the Z-score. Look at the cash flow. Cash is truth. As long as that $4.6 billion number stays high, they are nowhere near bankruptcy.
All right, let's bring this in for a landing. We've looked at the good, the premium revenue, the cash flow. We've looked at the bad, the competition from Southwest, the insider selling. What is the verdict? If you had to score this investment thesis out of 10.
I'm giving this an 8.2 out of 10.
8.2. That is a high confidence score.
It is. The thesis is simple. You have earnings acceleration, you have safety in the balance sheet, and you have a valuation gap.
Let's talk about the trade. How do we play this? Because you said it's trading at $69.50. Is it a buy right here?
The stock is undervalued relative to its growth. It is trading at a PE ratio priced to earnings of under 10. For a company growing at 20%, that is cheap.
That is very cheap. Usually a company growing at 20% commands a multiple of 15, maybe 20 times earnings.
Exactly. The market is pricing it like a no-growth utility, but it's performing like a growth stock.
Yeah.
So my price target range is $82 to $88 per share.
And we are at $69.50 today. So what kind of upside is that?
That represents a potential 18% to 27% upside from current levels.
That beats the market average by a long shot. What's the timeline? Are we holding this forever?
I view this as a 12-month swing trade. You're buying now, holding through the year, and really looking towards that Q1 2026 earnings report in April 2026 to confirm the trajectory.
So we're positioning ourselves before the rest of the market realizes how good the 2026 numbers are going to be.
That's the strategy. Buy Delta for the earnings acceleration, stay for the balance sheet safety, and profit from the valuation gap as it closes.
It sounds like a classic value play with a growth kicker. You're buying a high-quality asset, probably the highest quality in its sector, at a discount simply because the sector itself is a bit unloved and because the market is distracted by the shiny object over at Southwest.
That is the perfect summary. And remember, while Southwest is surging now, trees don't grow to the sky. Delta is the steady compounder here.
I love it. It's always interesting to see how a boring company can actually be the most exciting thing in your portfolio if you catch it at the right moment.
Absolutely. And with that 20% growth guidance, 2026 is shaping up to be that moment for Delta.
Thank you for walking us through the turbulence and finding the smooth air.
My pleasure.
And to you listening, thank you for tuning in to Smart Wealth with Joshua. Before you go, think about this. If Delta succeeds in capturing the high-end leisure market in places like Hawaii, what does that do to the pricing power of every other airline? It might just force the whole industry to evolve. Something to chew on. Make sure to hit that subscribe button so you don't miss tomorrow's analysis. We'll see you then.